back to our podcast. This will be the final episode of this series on the legal foundation of establishing your new business. I am Adriana Balmos and joined once again by Olexandr Kyrychenko, partner with IMD Corporate and an expert in corporate and commercial law. Welcome, Olexandr.
Thank you, Adriana, and welcome all to our final episode of this podcast.
In our last episode, we explored the essentials of intellectual property rights protection. Today, we are turning our focus on the equally important topic, raising capital and the legal considerations involved. Let's explore this.
Yes, of course. There are a number of important considerations when it comes to financing. However, in essence, these come down to one of two options: debt financing or equity financing. So let's look at these in a bit more detail. Now, with debt financing, essentially, this is a financing method of raising capital by borrowing from lenders, such as banks, financial institutions, or indeed even private lenders, with a promise to repay the loan over time, always with interest. Now, unlike equity, there is no exchange of company ownership, issuance of shares, but the borrowed funds must be repaid notwithstanding the financial performance of the business. And these are often secured and guarantees may often be required. Now, the main advantage of debt financing is that you retain the ownership of your business or your company. There is no dilution of shares and there is no influence that is given to third parties over the management of the company or the direction the company takes. However, the downside is that you have fixed payment obligations, which can create a strain on cash flow. If the business doesn't perform as predicted, the pressure to meet these obligations can become significant and could result in financing being taken away from other parts of the business and thus hinder its growth. You will also find that these often come with a requirement for personal guarantees from the founders, which may and will put the founders' personal assets at risk. Now, the essential documents for debt financing include loan agreements, which obviously will detail the terms and repayment schedules of the loan, security agreements, which outline what assets are being used as collateral, and personal guarantees, as mentioned. Now, the security agreements will often involve debentures and charges against companies' assets, being floating charges or fixed charges, further charges over the shares of the company being held by the owners, and the intellectual property of the company. And where default occurs, lenders will be able to immediately enforce upon those charges or guarantees. And this could be of particular hindrance to a tech business where the lender may potentially have the right to sell off valuable intellectual property to would-be competitors. Now, before opting for debt financing, it's important to understand the impact that it will have on your cash flow, as loan repayments will need to be made regularly, whether or not the business is profitable. Lenders may also impose covenants, such as conditions or restrictions on the business, such as maintaining certain financial ratios, not taking on additional debt, not being able to restructure, not being able to take on new shareholders or give up the control of the company without it being a default of that particular loan application. Now, the risk of defaulting on a loan can be serious, potentially leading to asset seizures or even a liquidation of the business.
Let's turn to equity financing. How does this approach differ? Let's also mention the advantages, disadvantages, and legal documentation essential for equity financing.
Well, yes, of course. So equity finance is essentially anything other than debt financing or anything other than injecting your personal capital into the business. In short, Equity financing involves raising capital by selling shares of your company to investors in exchange for funding. Now, this method is popular with startups looking to accelerate growth without taking on debt. It is a very viable option. When you sell equity, you're essentially offering a piece of your business in return for cash that can be used for operations, expansion, or product development. Whilst company structure does allow for different classes of shares, including such the different voting rights to be issued, in reality, investors are likely to want to ensure that they have control over the key decisions and may even wish to introduce their own members to the board. As such, it will not necessarily be acceptable to issue shares with no voting rights to investors. Now, the major advantage of equity financing is that you do not have to repay the money if the company does not make a profit, which is very much the opposite of debt financing. This means that no fixed interest payments or pressure to meet financial obligations in the short term, unless investment agreements say otherwise, or unless you're given substantial parts of your business to private equity investors. Additionally, investors often bring more than just money. They often offer valuable expertise, networks, and guidance. And this can be particularly true of what is known as angel investors, who invest in businesses in the early stages of their development, or indeed private equity or venture capital, looking to introduce their own management team in more mature stages of the company's growth cycle to take the company to essentially the next level. However, the downside is that selling equity means diluting the ownership and control of the business. In addition, equity financing can and often does bring pressures to scale up quickly, as investors' main expectations is rapid growth and profitability to maximize their share value and return on their investment, be it via dividends or exit strategies. To formalize equity financing, several legal documents are involved. These include term sheets, which outline initial agreements between the company and its investors, shareholders' agreements, inevitably, or investments agreements, which set out the rights and obligations of the shareholders and investors. Amendments to articles of association will certainly be required, and these are necessary if you're altering the company's structure or governance to accommodate new investors and new investor rights, with the new investors requiring such accommodation of their rights. Now, the investors will likely be keen in their rights being secured under the agreement, including matters such as veto powers over key decisions. They'll also want to make sure that there's a clear exit strategy, i.e. how and when they can cash out, whether this being through acquisition, IPO, or other means. As such, these do bring pressures on the business owners. So at the early stages of your startup, it is critical to know of all different avenues on which you could raise funds. And it is also very important to know of the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme, which are UK government-backed initiatives designed to make investing in startups more attractive. And now these offer tax reliefs to investors that reduce their financial risk, in effect. These provide significant tax relief, including potential capital gains tax exemptions if the company performs well. Your company will, however, need to meet specific criteria set out by HMRC in order to qualify for SEIS and EIS. And your documentation, your investment documentation, will need to be fully compliant with the requirements. This can have the effect of attracting more investors or bigger investments. However, even investing under this scheme, whilst your investors will receive these tax breaks, they will also receive equity in the company, as essentially this is equity financing. It will require you granting certain shares to the investors. And such investors will likely, certainly, also have an exit goal in mind. As such, the proposals to investors with the exit goal has to be well structured and thought out.
Thank you, Olexandr, for this insightful information. This concludes our today's episode on raising capital and the legal considerations involved. This also concludes our podcast, this being our 5th and final episode.
Yes, thank you everyone for joining us on this journey. And we both sincerely hope that you have found this podcast useful, and this is the knowledge that you will be able to take away.
Yes, and don't forget to follow us on our social media channels and our website for more insightful information on different topics. Also, we will see you in other podcasts, so stay tuned.
Yes, goodbye everyone. We'll see you in the future in our other podcasts.